Welcome Pure Investors, I'm Nick, and this is your April 22 update for the Pure Income and Growth Fund. We're pleased to report that the fund delivered a positive 0.5% return in April and initiated a new investment in the commercial construction, repairs and maintenance sector. More on this later. April proved a month with few places to hide for most asset classes, with May continuing the trend so far. Bonds, equities, property and crypto have all come under significant pressure as yield curves around the globe have ratcheted higher. Indeed, the ASX Small Ordinaries Accumulation Index is down almost 10% since the end of March to current. Whilst we expect volatility and uncertainty in financial markets to remain for the foreseeable future, we do start to question whether yield curve expectations are now a bit out over their proverbial skis, with unprecedented global debt requiring smaller rate hikes to have the same impact on hip pockets to slow inflation. Should yield curves have overshot, we may then well see 2022's underperformers to date, being small caps and growth stocks, become the outperformers later in the year. Time will tell, of course, but either way, this market is good for Pure, with a noticeable increase in inbound deal flow from companies unhappy with their equity prices. Turning now to our position initiation this month. We initiated a new position in Old Fields Holdings Limited via a senior secured $5 million facility with a 9.75% interest rate and a 62% warrant premium. Founded in 1916 and listing on the stock exchange in 1960, Old Fields has a long and rich history as one of Australia's leading painting tools and commercial scaffolding suppliers. In years gone by, the company dominated painting tool supplies in Australia before cheaper imports and a handful of strategic commercial errors derailed its dominant market position. However, over the last couple of years, the company has taken great strides in rebuilding its market perception and position, once again increasing its distribution points for commercial paint supplies amongst Australia's largest distributors. COVID impacting on commercial construction and supply chain issues out of China have obfuscated much of this operational progress though, and equity markets can't see it. And we expect that as the company trades out of these challenges over the coming 12 months and continues to build out sales across its rekindled distribution relationships, that equity investors will come to see the earnings potential of Old Fields. We have termed our facility with Old Fields at 4 years, giving us plenty of time to capture capital growth in the facility. We look forward to providing you with updates on our investment in Old Fields, and if you'd like to learn a bit more about the investment, please see the newsletter accompanying this video. Turning now to Energous, we'll be the first to admit that after having initiated an investment in Energous last month, we didn't expect to be back updating you on the company so soon. However, we're very pleased to share that shortly following our investment in the company, Energous was awarded a $5.5 million grant from the federal government. This was not in our investment thesis and means the company is now capitalised for work over and above its forecast, which is good because that work appears to be flowing. Further, an additional circa 25% of financial year 23's $22 million revenue forecast for Energous is now underwritten, with the company securing a major project to provide Sealink with a hydrogen power plant for the construction of a world-first hydrogen-powered passenger ferry. This project has also received $5 million in funding from the Queensland Government to Sealink, which will partially flow through to Energous in completing this project. We're very pleased with the progress in Energous and believe the company is shaping up nicely as an IPO candidate for later this year or early next year, and we look forward to providing you with more updates on the company over the coming months. Turning now to the outlook for the fund, despite the uncertain times, we remain cautiously optimistic on the potential of the Income and Growth Fund portfolio in the near term. A positive revaluation led by a third-party investor in a private investment will assist May performance, where, despite the market foibles, the fund is currently delivering a positive return on a mark-to-market basis. We note the fund continues to anticipate a number of positive catalysts in addition to holding 7 private debt investments at cost, reflecting no equity value for those investments, which account for approximately 20% of the NAV, as can be seen in this chart. Finally, with warrants and equity at less than 15% of the NAV, we believe there is a positive asymmetry of risk in the portfolio that investors have not seen for approximately 18 months. Thanks for your time, and we look forward to providing you with a further update next month.